Good morning and welcome to our weekly webinar series. Today's webinar is definitely a special installment in our OLSHF webinar series. Most of our webinars, for those of you that have participated in the past, and we're grateful for you to do so, have been pretty much program oriented, sharing how we're helping people with hearing aids and hearing assistance through our ROAR program. We've done webinars on the school vision screening, of course. And today is going to be a little bit different. It's going to be really unique, and we have a special guest that I will introduce to you in a moment. I'm Doug. I'm the Executive Director of the Oregon Lion Sight and Hearing Foundation. We also have Brenda Anderson, who is moderating and facilitating our webinar. You'll hear from Brenda here shortly to Brenda, in a moment here, I'm going to have you tell people where the chat box is and those types of logistical items.
Sounds good.
But in fact, why don't you start with that, and then I'll introduce Brad. Does that sound okay?
That sounds great. Thank you so much, everybody. Welcome to this installment of our webinar series. We're really thrilled that you all are joining us. Just as a kind of housekeeping on here, you as an attendee are in listen-only mode. That allows you to see the screen if you're joining us on your computer system and hear us through the audio. If you're calling in and just listening, that's fine too. You have the ability, though, if you are on the computer system, to chat with us. There is a chat box where you can type in and talk to us and send us questions. And there's also a question box where if you put that information in there, we can pass those questions among ourselves and answer those during the session. If you have any questions at all, please don't hesitate to use that chat or questions boxes, and we'll be happy to help you however we can. Thanks, everyone.
Thank you, Brenda. I appreciate that. And why don't we go ahead and go to the first slide here. For those of you, and it's probably most of you, that are familiar with the foundation and have been supporters of us for some time, are probably very familiar with the fact that we like to tell people, because it's true, that when you make a donation to the Oregon Lions Sight and Hearing Foundation, that 100% of your gift supports our programs. And there's really a couple of reasons for that. Partly it's because we have free occupancy, and so we don't have any expenses related to that type of overhead. A big part of it, though, is because we have long-term investments that you're going to be hearing about here shortly, that we're able to draw a small percentage of the principal of these investments, and it covers all of our administrative expenses. So when we tell you, as that bubble in the lower right-hand side says, that 100% of donation support programs, we're not trying to say that we don't have administrative and fundraising expenses. We do. In fact, Brenda, why don't you go to the next slide? But our administrative and fundraising expenses, while they're modest, in fact, Charity Navigator gives us a 4 out of 4-star rating in terms of our financial activity, and a 100% accountability and transparency rating. Our percentage of administrative and fundraising expenses is only about 15% of our overall budget. The Better Business Bureau wants nonprofits to have no more than 35% of their expenses being administrative and fundraising, and we're at a very healthy 15%. But even then, that 15% is all covered by our own long-term investments and the small amount that we draw off of that. So I just wanted to start off by letting you know that that is how we can honestly tell people that 100% of your gift goes to help people with sight and hearing programs. Now, these investments are managed by Ferguson Wellman Wealth Management, recognized by Forbes magazine as one of the top 25 wealth management organizations, well, I think in the country, maybe in the world. I'll let Brad mention that. Brad Houle is our investment manager at Ferguson Wellman. He does a fantastic job of communicating to us, of ensuring that our investments are within our board-approved guidelines. And Brad, at this point, in addition to thanking you, I'm going to hand it over to you. I'm going to disappear for a while and let you tell us about OLSHF investments. Thanks for being here, Brad.
Oh, my pleasure. Thank you for the invitation. Appreciate it. Today, I'll probably only take about a half hour. I'd like to talk about and just give folks a quick introduction to who is Ferguson Wellman. Some of you might not be familiar with the firm, and then touch on at a high level the investments that we manage on behalf of the Lions. And then we have an economic and capital markets outlook for the rest of the year that I'd like to share with you. So if Brenda, you could advance to the next slide. So Ferguson Wellman is 40 plus years old. We are a Portland firm. We have about 50 employees, and we manage almost $6 billion for 878 clients. Our team, we have 24 investment professionals with an average of 22 years in the industry. And what we're very proud of is that we've only had one investment professional leave in the last 27 years, other than retirement. So it's very much a career destination. And why that's important to clients is in these long-term relationships, like we've been able to have the privilege of working with the Lions, that continuity of employees is very important for retaining institutional knowledge and to guide the clients over long periods of time. Advance, please. When you hire Ferguson Wellman, you hire a team. It's very much a team-oriented approach. When we speak of clients at Ferguson Wellman, we refer to them as clients of the firm. You don't say my client at Ferguson Wellman. I wouldn't say that. I would say our client that I work with. And that's an important distinction because it is a team approach to service. So for example, I am the head of fixed income and I work with clients. If I have a question on behalf of one of our clients relative to trusts and estates, then I can ask one of my partners, Mary Lago, to step in. She has forgotten more than I will ever know about trusts and estates. So clearly the clients benefit from that comprehensive team approach and having a broad array of experience, both in terms of tenure and expertise that can benefit all of our clients. And the Lions, we've had the privilege of working with for more than 18 years. Next slide, please. So we will now get into the performance of the Lion assets and how this is, it's very high level. There are many sub-accounts that are managed for different purposes, but in total, and that's what I'll show you in the next 3 slides, we manage about $6.8 million for the Lions. And this is all of the sub-accounts rolled up into one, so you can get a sense of the investments. So this is the performance on a fiscal year to date, and it's up about 7%. So if you look at the box in the bottom, the assets of the Lions are the copper colored bars and the blue bars are the benchmarks. And we have complete transparency, and this is how we grade ourselves. And ultimately, we want to be ahead of the relevant benchmarks. Advance, please. So what really matters for investing is long-term investments. And if you look at the upper left, you can see 18 years and 2 months has been the Ferguson Wellman relationship with the Lions. And the return since inception is up about 200%. If you break that into year increments, that's 6.34%. And that is an expectation of, it meets expectation, exceeds expectations of how we would expect a client such as the Lions, your risk, your needs and objectives and risk tolerance, that's about the performance we would expect. Next page, please. One more. This is, again, all of the accounts combined, so $6.8 million. This is a snapshot of the asset allocation. So that is the mix of stocks and bonds and other assets. And that is the most important determinant of what is the outcome of the investing results, and the amount of risk is the asset allocation. Now, this asset allocation is, our most important job on behalf of clients is being risk managers, helping clients figure out how much risk they can take and managing that risk. And what really drives most of the risk is the mix of stocks and bonds. And we'll talk more about that in our outlook, because there's definitely some changes afoot in the fixed income markets. But this account is about 26.9% fixed income, and that's your anchor to windward. And then the other assets, by and large, are more equity or stock related. Now, if you look at the Lions and how this is invested, it is very equivalent to what we are doing for other organizations of similar needs and objectives. roughly 30% of Ferguson Wellman clients are individuals and families, and the other 30% are institutions like the Lions. And this is very close to what we're doing on behalf of other organizations that are very similar in terms of, no, not the exact mission, but that are mission-driven, nonprofits with, similar needs and objectives and risk tolerance. Next page, please. So this is drilling down into the sub-account. So the total value as of September 1 that Ferguson Wellman manages for the Lions is 6.8 million. And then the accounts listed below are the sub-accounts that are carved out for different specific purposes, and they're managed differently in slight ways for what the purpose of those different buckets are. So for example, if you look at the top one, it's the long-term fund. That's the endowment. The value is $5.7 million. This is the largest piece of the Lions assets. Much of, or a good bit of this money has come through bequests. And so Lions who want to leave a legacy, or other folks, have donated to this over time. And this is, 2.1 million of this is restricted, but this is the largest part of the corpus that the Lions use a small fraction of each year in order to meet operating expenses. And there's a gentleman, Gene Christian, that works with the Lions that helps folks to include the Lions in their estate plan if that's a legacy they want to leave. Another one to highlight is the Sam Tyler Commemorative Trust Fund, and that was carved out in order to help people in Lane County with vision needs. It's a $123,000, and it helps about 50 people in Lane County with vision needs. Next page, please. Next page, please. So that's the overview of the investments of the Lions and how Ferguson Wellman manages on behalf. And when we get to the end of the presentation, there'll be plenty of time for questions, and I will be happy to entertain or answer any questions that anybody has about what our approach is and how we manage money for the Lions. So we, each quarter, we pick a theme, and that theme is part of an overall annual theme of, we like to give our clients an idea of how we see the world and what we see coming. And we use this also as a mechanism to telegraph where we're going to go with client portfolios. We move very deliberately, and we always want to telegraph our thoughts and what the next moves in the portfolio would be for clients. And so this year's overall theme was the Rolling Stones, and it was age is just a number. And it was the longest economic expansion really in US history. And it was good to compare the Rolling Stones because in their mid 70s, they're out still touring, or they were. And then the COVID came along and was the quickest recession in history. And so this theme, Start Me Up, is about the restarting of the economy, which we're starting to see. Next slide, please. Next slide. The former page, the previous page was a summary, and we'll hit all the topics in there, so I won't read it to you twice. The largest question that we get from clients, and really, if you think about it, probably the biggest question is, all these people are unemployed. The economic data you hear about, at least up until recently, has been characterized as being the worst in history, or the worst since the Great Depression. And yet you have a stock market that has gone straight up. Like, how do you reconcile those things? Well, this is a graph, and the takeaway here is that the market leads the economy. This is a graph of employment through the Great Recession, so 2007, 2009. And the green line is the market, the stock market, the S&P, and then the dashes are non-farm payrolls. The takeaway here is that the market bottomed in March of 2009 and then went up and to the right. It went straight up, and yet payrolls, employment, did not heal completely until 2014. And so what happens here is that the market is a forward-looking entity. The market looks forward at where it sees the economy going, and that's why you have such a strong uptick in the stock market. The market is assuming that there will be a vaccine and that we've passed the bulk of the really bad economic data. And that's why, even though things still feel pretty bad, there's still there's huge unemployment, but why the market has gone up. Next slide, please. So this is a depiction of how we expect this recovery to be. So this is GDP, this is the growth of our national income. And if you look at the dashed line, that's what GDP would be without COVID. Now, if you look at the check mark here, looks like a Nike swoosh, the economic growth dropped dramatically when COVID hit and the economy basically shuttered. And we have gone past the apex and we are now here where the yellow circle is, so starting to trend upward. The ideal scenario would be a V-shaped recovery where you'd have this sharp drop and then a quick bounce up. It's not going to quite be that, but it's going to be decent. So what the assumption is here is that there will be a vaccine within the next reasonable period of time, call it 6 to 9 months, and then we won't have a vicious second wave of the virus that we've seen the worst of it. And this will look different. This recovery will look different if, in fact, that one of those things, if the vaccine is somehow delayed, or if we have a very bad second wave of the virus, the recovery is going to take longer. But I mean, thinking about the slide from the previous page, the economic data for 2020 will be horrible. There's no question about it. The earnings on the stock market, so if you take all the companies in the stock market, you put them in one bucket, also going to be down significantly. But what the stock market looks at is earnings for 2021 and 2022. And there is an assumption of a pretty good resumption in economic activity. Next slide, please. So the takeaway here is that housing is leading the recovery. And if you think about it, it takes a ton of consumer confidence to buy a home. So if you look at the housing stats, home starts have surged most since 2016. Home sales are up 21% in June. Mortgage rates are an all-time low, which has spurred both new purchases as well as refinancing. And Home Depot's quarterly sales are high. So remodeling is also, very, very strong. And this is a good sign for the economy because it takes so much consumer confidence to buy a home, that this resumption in housing activity shows that, if folks are employed, that they're feeling confident about the future. And the consumer is 70+% of the US economy. So how the consumer is feeling is very important. And, our view is that people have spent so much time in their homes because of the lockdown. It has caused them to very much evaluate, how they feel about where they're living and how they're living. And so I think we think that has spurred a lot of this housing activity. Next slide, please. So this is the most important aspect of the recovery and the thing that we truly know the least about, and that is the path of the virus. Dr. Fauci says that the virus will set the timetable, and we believe that is very true. There's a ton of data you can look at on COVID, and many in our industry have become amateur epidemiologists, and we are certainly not on that path. We are reading different things and are as in the dark as anybody else who's not a scientist. But the thing we are focused on here is that hospitalizations have peaked and have come down. Hospitalizations and ICU usage needs to be kept below crisis levels in order to keep the economy open. And we believe that as you have these hotspots around the country, that they're going to be dealt with on a case-by-case basis, as opposed to a draconian coast-to-coast shutdown of our economy. That is clearly not in the scenario of the checkmark recovery, but we believe that our economy, and you're starting to see this, is starting to adapt to this environment. businesses adapting, people are adapting, and there's definitely some industries where, if you're a cruise line or if you're an airline, it's more challenging to adapt. But we believe that, we are, closer to the end than the beginning of the COVID crisis. Next slide, please. So in addition, jobs are key to the recovery. This is a graph of continuing jobless claims. So what this is, when somebody files for unemployment, then their week-to-week continuing unemployment claims are measured here. Now, this peaked out at about 25 million people and has since declined to about 14.8. For context, this is normally around 1 to 2 million people a week. And so you can see with COVID, how elevated this is. The good news about it is that 2/3 of these folks who are furloughed expect to be back at full employment. The longer this goes on, the more permanent job losses will result from these folks that are on unemployment. Now, this number peaked at about 7 million people. We had permanent job losses of 7 million in the Great Recession, and it took a decade to get that back. If you recall, the unemployment rate prior to the COVID crisis was at 3.5%. The unemployment rate peaked at about 14% in March. It is now declined to about 10.5%. So getting back to that low of unemployment is going to be a long slog, but the market is definitely taking that into account. Next page, please. So this next slide, the takeaway here is this is about monetary policy. This is about the Federal Reserve, the central bank, and their financial engineering to rescue the economy. This is a growth of the money supply. And when things started to go very bad in the month of March, the Fed stepped in a very big way. So what's really striking about this chart and is both the speed and the magnitude of the response. $18 trillion in 2 months as opposed to $8 trillion over 24 months, what we saw in the financial crisis. And what happened was towards the middle of March, the underlying pinnings, the plumbing of the market started to not work. And this is something where it started to remind myself and my colleagues of the financial crisis. So what you had here was a public health crisis that had become an economic crisis that was on the cusp of becoming a financial crisis. And a financial crisis again, and that's when the plumbing of the market stops working. And so around the middle of March of this year, we started to see things like treasury bonds, which are, you could say, the largest, most liquid market in the world. There was a lack of liquidity for some issues, and that is troubling. And the minute that the Fed stepped in, that went away, and markets started to function normally. So this is good news. The Fed Chairman Powell, he gets an A+ from Ferguson Wellman. He has done a very good job of communicating and reacting. The Fed in the financial crisis, they moved slowly and asked permission. This go around, the Fed just jumped in and did what needed to be done. And then last week, there was an announcement by the Fed that they are not going to proactively raise interest rates because they're worried about inflation. And we'll get to this on the next slide, but the Fed is willing to let inflation run a little bit hotter than it has in the past. And that is the takeaway there is interest rates are going to be low for a long time. And that's very supportive to asset prices. Next slide, please. So this is more in line of interest rates. So the biggest question, or another, I guess the second biggest one we get from clients is all of this liquidity, all of this response, all of this debt that is being accumulated for the COVID response, will that lead to inflation or a crisis in the future? And it's a great question. And our national debt is going to grow $3 to $4 trillion a year, which is very material. And it works opposite of how you would think. You think like you're building this giant debt pile that's going to be inflationary, but in fact, deflation or falling prices is a larger risk than inflation. The more debt that a country has, the more that is a drag on growth, and that has a tendency to push prices down. In addition, we have an aging economy. Demographically, we're aging, and that also is a hindrance to growth. So we believe that deflation is still a bigger risk than inflation. Inflation hasn't been a problem for 25 years, and we don't anticipate it being a problem for the foreseeable future. Now, this graph is a graph of the consumer price index, which is a way that inflation is measured, and the 10-year Treasury. And the takeaway here is that the largest determinant of long-term interest rates is the current and prospective rate of inflation. And we don't see inflation increasing, and therefore we think longer-term interest rates, 10 years, 15 years, 20 years, are going to remain low for a long time. Now, the Federal Reserve controls overnight rates, but longer-term rates are controlled by the market. And so this should be supportive to, again, to asset prices, to companies. Borrowing costs are lower. And then if you're thinking about buying a home or refinancing a mortgage, there's probably no rush. We don't see interest rates moving higher. Next slide, please. So with the stock market going up, and this is interesting to talking with you today because there is a very large correction going on, a sell-off in the companies I'm about to talk about. So the stock market was actually, as the S&P, and this is through the end of July, and this actually was even more pronounced in the last few days. It's up 2.4%. But it's been a very narrow rally. So if you look at what's called the FAM stocks, which is Facebook, Alphabet, which is Google, Amazon, Apple, and Microsoft, those companies are up 38%. If you take those companies out of the S&P 500, so out of the stock market's actually down. And so there has been a ton of money chasing a very few companies who are, benefiting from work from home and people staying home and are showing visible growth. And then interestingly today, for really no good reason other than, what's called technical reasons, the S&P 500 is down 3% today, and particularly these technology companies are declining about 5% on average. And so it's just a normal correction of something that's just been going parabolic for some time. Next slide, please. So as part of our process, we will adjust the portfolios for clients based upon our view of the world. And we've had this downturn. We've had what's probably going to be the shortest recession of all time, and now we're in a recovery. And so what we are doing is tilting away from defensive sectors like consumer staples that do well in a downturn and are moving towards companies that do well in an expanding economy. And this is in a reversal of a trend where we'd had such a long economic expansion. We had been getting more defensive in the portfolios really for the last 2 years. And then after this crisis, we are changing course to take advantage of the recovery. So that's something that's ongoing through client portfolios. Next slide, please. And next slide. Some of you might have heard that there's an election, and that we get there's a lot of client discussion about the election and what happens. And the takeaway of this chart is that the market has a tendency to go up over time, regardless of who's in the White House. Now, elections are not generally capital market events. You can have turbulence around an election, but policies are what really drives the markets are actual economic activity. Policies and tax changes can impact them, but it takes time. And as a result, depending on the outcome of this coming election, we're not too concerned. It can be impactful to certain sectors. For example, if there's what's called the blue wave, that's probably good for managed care companies and insurance companies. If the Affordable Care Act is, somewhat reinstated to what it was in the Obama administration, or conversely, if you have the incumbent win, that would be probably good for defense stocks. Now, one caveat to this, if the election is, should we say, unconventional, and it's difficult to declare a winner for a time. That could create some angst in the market, but it shouldn't be any long-term damage. Thinking back to the year 2000, when you had the state of Florida influx, the hanging chads, all of that, that did cause some market turbulence. So I think the best thing about the election is that at some point it should be over. And then next slide, please. This is how we're thinking about asset allocation going forward. So the mix of stocks and bonds. Interest rates are so low, and we expect them to remain low, that we are rethinking what a normalized weighting of bonds is in a client account. And as a result, we are going to be leaning more on alternative investments in the future in order to generate income for clients, and as well as adding to more, in some cases, dividend-paying stocks. And this is something that we'll be talking about in the future, and this is all within the context of client guidelines. But if the 10-year Treasury is going to be, just a bit over 0.5% for the foreseeable future, then we need to think about different ways to generate income. And by alternatives, I mean things like commercial real estate, what are called real assets, so infrastructure, farmland, those are investable assets. And then we're also using an alternative income fund. And there's some puts and takes to these strategies. On one hand, they provide more income. On the other hand, they don't provide as much protection as bonds do in a sell-off. Bonds are what's called inversely correlated to stocks, and when stocks sell down sharply, bonds usually increase. But as we approach zero with interest rates, or we're very close, then you lose some of that protection. This is our crystal ball for right now. I would say it's a little bit more hazy than usual. I would love to answer any questions that anybody might have.
So one question, and I'm not sure, actually more of a comment on regards to the unemployment and some of the impacts of that unemployment on the outlook, because it said that a lot of the outlook relied on the idea of the jobs and getting the workforce back in there, and then with the unemployment taking quite a while to possibly come down to more standard or traditional levels. Can you just talk a little bit more about the impact of unemployment in that long slog and how that might be overall for just the outlook?
Yeah, absolutely. So the unemployment rate, 10.5, it's come down dramatically as the economy reopened from March until now. Getting back to that 3.5, it's going to be a good long while. If we could get back to 5%, that's a pretty normal level of unemployment. And it's interesting, if you look at the demographics of unemployment, it has definitely hit lower income folks worse. If you think about people in the service industry, they can't really work from home, but more knowledge workers, folks that can work from home, and that has a tendency to be higher income folks in our economy, have actually held up a lot better. And that's something where the enhanced unemployment insurance, I have to hand it to Congress, did a good job. They acted quickly, that was generous, and that was important to get the economy back on its feet and provide some income replacement. That is starting to wane now, but the economy is opening up, and that's a question we have: is that will there be enough support for unemployment to bridge that gap between now and when our economy is truly open?
Thank you so much. And Doug, I didn't mean to interrupt there. Sorry about that.
Oh, no, that's just fine. We welcome any and all questions from our audience, so thank you for that one. Brad, I always appreciate being able to utilize you as you and your crystal ball to get a little bit of a glimpse at what the future holds. However, though, to move it back to the foundation's investments, could you speak a little bit more about the process of communication with our finance committee, in terms of adherence to our investment guidelines. And for those that aren't familiar, just to kind of help them understand how you help us stay within our own investment guidelines and that communication process in terms of managing our investments?
Sure. I talked about this, like our most important role for clients is being risk managers, determining what an appropriate risk level is for clients. And you think about it this way, if you're in traffic, the fast lane is always going to win. But if you're not suited to be in the fast lane, then what's going to happen is you will get out of the fast lane at the exact wrong time. And that's what happens, because you think about if you are a board of trustees and you are losing money and you feel like you can't take it anymore, you'll get out at the wrong time. And so these things evolve gradually over time, but they don't change in dramatic fashion. But we set up guidelines, so that's the percentage that we put in risky assets versus safer assets, and that's something that's reviewed continually when we're meeting with the finance committee. That's a point of discussion. It's like, where are weightings? Do we recommend any tweaks to that? And it's something where it's an ongoing dialogue, and we monitor that, because as I mentioned, we pick stocks, we manage with individual stocks, and how good we are at picking stocks is important. We want to beat the benchmark, but what really drives the train, what really is the largest determinant of outcome of investment, is what the asset allocation is, what the mix is between the different asset classes. And that's something where you have to look at needs and objectives and meeting the mission of the organization. And the Lions needs a small amount each year in order to fund the operations. And we don't want to be in a position where we are too risky and we have to sell into a severe downturn in order to meet that obligation. So it's an ongoing process, and it evolves very, very slowly over time.
Thank you for that. I just wanted to, since you mentioned it too, with the asset allocations relative to that, answering that question, we received a comment from Belinda who says, wow, impressive in presentation, realistic expectations with appropriate asset allocations that reflect those expectations. Thank you. So I wanted to pass along Belinda's kind comments. And then Jim asks, moving towards alternative investments, are you including hedge funds?
We do utilize hedge funds on occasion. It is something where I don't know that it's a good fit for the Lions. They're not, the ones that we utilize are, they're not really set up to produce income necessarily. And if we are going to be pulling assets from bonds, then we want to replace it with an asset that is something that generates income. And that is, things like commercial real estate, the real assets I mentioned, like infrastructure funds. And that's things like infrastructure, if you think about it, they're long-lived income-generating assets. So one of the type of things that would be in an infrastructure fund would be like cell phone towers. Cell phone towers are, you put them up, you charge rent to the wireless carriers, and you have to paint it like every 5 years. That's it. It just generates income. It's a great business. So you want to pool a bunch of things like that in order to generate income. But this is something where these assets provide income that's well and above what's available in the bond market, but they don't have as much downside protection. And that's there's puts and takes, there are trade-offs, and it's a delicate balance between having enough of that built-in protection, yet generating more income in order to meet the mission.
Thank you so much for that. One of the other questions we received is, what are your targets for the S&P 500 by year end?
The S&P was up, I think 7-8% prior to today. That's a tough one. Our view is it will be positive, probably not, appreciably more than where it's at. The bounce off the bottom has been more than 50%. So it's pretty logical that you would see a pause in the S&P. Because if you think about it, this year's earnings are terrible. 2021 and 2022 are what the stock market is trading on. And there's not a ton of visibility around that yet. And so it is more of, just conjecture that the economy is going to open and it's going to get better. And, we believe that we're going to have that checkmark recovery, and we want to remain fully invested in equities. But, it's not going to be a smooth ride from here to there.
Thank you. And another question we received is, with the changes you see and what you know about the foundation's risk tolerance, are you going to be recommending any adjustments to the asset allocation?
I think that, kind of what I was talking about, I think, the bond allocation in aggregate is down, I think 3% since last year. That is probably being closer to the lower end of the range for fixed income, and more alternatives would be the only thing. And then, possibly a mix shift. We've been discussing opening an account that uses dividends as another way to generate income. And so that's another, not necessarily a change in asset allocation, but potentially a change in the mix of the stock market exposure.
Thank you. Doug, I had another question, if I'm not being on there. And this one's in regards to the national debt. And I know you had mentioned that, some of that the debt is relatively inexpensive at the moment, but of course you hear these growing numbers. And I do wonder how that, historically high debt for our country is impacting some of this outlook.
Our national debt, it used to be that politically there was one party that was, fiscally responsible and the other one was not. Well, that's kind of out the window now. It's spending has bipartisan support. And as a result, we have what's really tantamount to a blank check from the global debt markets. The US dollar is the reserve currency of the world. And there is an insatiable appetite for US Treasury bonds. They are the most liquid, the safest investment, and dollar denominated, and that allows us to borrow for 10 years at slightly over 0.5%. As a result, that makes our debt pile pretty affordable. If you look at the percentage of our GDP, our national income that goes to service the debt, it is really pretty low relative to the past, because even though the debt pile is larger, the interest rate we're paying is very low. And so you have this situation where we can borrow and there doesn't seem to be an end in sight there. But at some point, it's kind of the ultimate kick the can down the road problem, where shoring up the debt and cutting spending, which would definitely not be the right plan now, that's not in the get reelected playbook. And so as a result, you're going to see this problem get kicked down the road, and this is our grandchildren and great-grandchildren's problem.
One more question that we received from Jim, and this says, how much optimism do you feel is already baked into the market? For example, or restated, is the market more exposed to bad news than good news?
That's a tough call. If you look at the valuation of the market, so one way you look at valuation of the market is what's called the price-earnings ratio. And so what that means, it is the amount that investors are willing to pay for $1 of earnings. It is above average, but not by a ton. So that would tell you that there is some optimism baked in there. That said, when you have interest rates that are this low, that is very supportive to stock prices. So thinking about the market, we don't view it as a bubble. If you think about right around the tech bubble in 2000, the valuation of the market, what investors were willing to pay for $1 of earnings, was well beyond what it is now. Now it's really pretty subdued by comparison. However, there's been little or no volatility since the crisis has been straight up. There's some bumps on the road, but we are, if you think about the technology companies that are leading the market now, they're far more profitable than they were in 2000. In 2000, there was a lot of sunshine built into the expectations for companies that didn't really make any money. Not a bubble, but definitely it's not an undiscovered asset class either.
Thank you so much. Those are all the questions that we've got here. Go ahead, Doug.
Hey, Brenda. You can hear me, right?
Yes.
I sure can. Yes, thank you.
Okay. My mute button, the light went off, so I can't tell if you can hear me or not. Hey, I want to put in a plug for our webinar, I believe in 2 weeks from today on September 17th, when we will have Gene Christian, who we work with in terms of estate planning. And Brad, I appreciate you alluding to earlier, really the fact that the majority of our investments, these dollars have come to us as a result of people writing us into their will, building us into their estate plan. And some of those long-term investment funds that you showed us, Brad, are, again, a direct result of individuals remembering the Lions Sight and Hearing Foundation in their will. In 2 weeks, Gene is going to inform us a little bit about some of the critical tools that we should all have in our estate plan: power of attorney, a will, of course, a living trust. And he also has a document called My Final Wishes, which we can provide all of these resources to all of you at absolutely no cost, but also with no strings attached. I know that sometimes over the years when I talk to people about estate planning, they look at me kind of funny as if I'm trying to twist their arm to write us into their will. And I'll admit, we hope that people will do that, but we will provide all of these resources to any Lion with no strings attached. Admittedly, I think 70% of the people that do meet with Gene end up remembering the foundation in their will, but it's not required. In fact, it's confidential information. We won't even know the results of your visit with Gene. So that's a really long, rambling plug for tuning in 2 weeks from today on September 17th. But for now, Brad, I really appreciate your expertise, your skill at managing our investments, but also your genuine interest in support of the Oregon Lions Sight and Hearing Foundation. Now, we do know that you're a wonderful customer of I Promise Optical, and we thank you for that. But in all seriousness, your understanding of our programs, whether it's school vision screening or our LEAP, optical lab, you truly understand and know firsthand how we have an impact on people's lives. And I believe that it actually helps you in terms of an appreciation of managing our funds, knowing the importance of how people benefit not only today, but way down the road for years and years. People will benefit from the Lions Sight and Hearing Foundation because of your work and your expertise. So thank you so much for that.
My pleasure, and we are just so grateful for your business, and it is such a privilege to work with the Lions. If anybody has any follow-up questions, Doug and Brendan know where to get a hold of me. Feel free to reach out. If we can ever be of any service, let me know. And it's been a great privilege to speak with you today. Thank you.
Thanks again, Brad. And then I also want to put in a plug, I guess, for the fact that this session has been recorded, and we will make it available not only on our website, but this is a session that we will send it to Lions clubs and Lions individuals so that they can watch this, because everybody probably wasn't available at 11 a.m. today on September 2nd. So we're recording it. If this is something you think your Lions club would like, let us know and we'll send it to you, and you can watch it at any time at your convenience. Brenda, I'll hand it back to you, and you can provide some parting words.
Excellent. Thank you so much, everybody, for joining us for this session of our webinar series. The Foundation will be hosting another webinar next Thursday at 11 a.m. I believe we're going to be focused on I Promise Optical and some of our items that we have there. We'll have Kelly and Katie joining us. Brad, I just want to say a special thank you to you and Ferguson Wellman. I learned so much from these types of sessions and from meeting with you, and just very appreciative of all the effort you make on behalf of Lions and the Foundation. And I hope everybody has a wonderful day. Thank you so much, everybody, and take care.
Thanks, everyone.
Bye all.
Thank you. Brad, we might ask you to be a model for the I Promise Optical webinar.